Welcome back to the Pro Ticker Podcast. It's your Saturday morning edition, covering major financial magazine headlines. Everyone, I hope you have your coffee ready, because we're diving into some pretty interesting market moves this week, especially with President Trump's second inauguration happening right now.
Yeah, it's certainly a unique moment, and the markets are already reacting in ways that might surprise you.
Absolutely. We've got a stack of articles here from MarketWatch, Bloomberg, and even Barron's. A real mix of market analysis, global trends, and even a little legal drama. And the big question seems to be, will Trump's policies usher in an economic boom, or are we headed for a bust?
Well, let's start with the outgoing administration. MarketWatch pointed out that Biden is leaving office with the S&P 500 up over 55% during his term. Sounds impressive, right?
It does, especially considering we had a pandemic in there.
That's true. But it's actually the smallest gain for the S&P since Obama's second term. Both the Dow and the Nasdaq also had their worst returns since George W. Bush's second term, according to MarketWatch.
So what's going on here? Is it really all about the president?
That's what makes this so interesting. The article suggests that other factors beyond just the president were likely driving the market. Think about the pandemic recovery, the AI frenzy that's been driving tech stocks, and the impact of the Inflation Reduction Act on certain industries. It's a much more complex picture than simply saying one president was good or bad for the stock market.
Okay, so nuance is key.
Okay.
But let's talk about Trump's potential impact. MarketWatch had a whole piece on the Trump trade and what it means for oil markets.
Yes, and we're already seeing signs of it. Oil futures are in what's called backwardation right now, meaning current prices are higher than future ones.
So what's that tell us?
It could signal that the market is betting on Trump boosting U.S. oil production, driving prices down in the future. But here's where the skepticism comes in. Oil analysts quoted in the MarketWatch piece aren't so sure U.S. production can increase dramatically from its current levels. Leveraged shares, for example, thinks it's unlikely in the short term, while CIBC Private Wealth suggests there might be more potential for growth over the long term.
So even the experts don't agree on this one. It's a real guessing game how this will actually play out.
Exactly. And we can't forget about the geopolitical factors at play here. Trump's potential policies could have a major impact on global oil markets, for example. Easing sanctions on Russia could lead to lower prices globally. But on the other hand, his strong support for Israel against Iran could create instability in the Middle East, potentially pushing prices higher.
Right. And then there's his stance on tariffs with China, Canada, and Mexico. It's hard to say what the net effect on oil demand and prices would be.
It's a complex web of potential outcomes, and that's why it's so fascinating to watch. But let's shift gears for a moment and talk about another pressing issue that Bloomberg highlighted: the debt ceiling.
Okay, yeah. Congress needs to act fast on this to avoid a government default. What's the latest?
Well, Buffer Global predicts that if there's no deal by April, the supply of T-bills could actually turn negative.
Wait, negative? What does that even mean?
It means there could be such a scarcity of T-bills that the government might have to start buying back existing ones, essentially pushing yields below zero. This could impact you directly, because a shortage of T-bills would mean you'd earn a lower, or even negative, yield on your own short-term investments.
So this isn't just some abstract political game. It could hit people right in their wallets.
Exactly. And Bloomberg mentioned a few potential scenarios for how this could play out. There's talk of using a budget reconciliation bill to address the debt ceiling, which could bypass the need for 60 votes in the Senate. Plus, Trump himself has called for abolishing the debt ceiling altogether.
That would certainly shake things up. But given the Republicans' small majority in the House, negotiating any debt ceiling deal is going to be challenging. Plus, there are those concerns about the potential economic fallout from Trump's policies adding fuel to the fire.
Right. There are a lot of unknowns right now. But while we're talking about potential market booms and busts, let's not forget about the world of crypto.
Oh, yeah. Barron's reported that Bitcoin surged past $100,000 this week. And other coins like XRP are seeing huge gains. Is this the beginning of the Trump crypto boom?
It's certainly possible there's speculation that Trump will prioritize crypto, maybe even creating a dedicated advisory council, similar to the Trump trade in oil. Just the anticipation and market sentiment around his potential policies are already having a huge impact.
That's pretty wild. It seems like everything Trump touches turns to gold, or at least some people hope it will.
We'll have to wait and see. But speaking of high-stakes gambles, let's pivot to a story from Bloomberg about the fallout from the Archegos Capital Management collapse. Remember that one?
Yeah. Wasn't that the firm that imploded and cost banks billions?
That's the one. And just this week, the former CFO, Patrick Halligan, was sentenced to 8 years for his role in the whole mess.
8 years. That's a hefty sentence.
It is, especially considering his defense was that he actually urged caution about the firm's risky trades. It's quite a contrast to his boss, Bill Huang, who received a much longer sentence.
Wow. That's a stark reminder that even in the world of high finance, there are real consequences for risky behavior.
Absolutely. And it highlights the human element behind these financial headlines. These aren't just abstract numbers, they represent real people making decisions.
Yeah.
And sometimes those decisions have devastating consequences.
Speaking of consequences, MarketWatch also covered the Department of Justice lawsuit against Walgreens for allegedly filling millions of opioid prescriptions without proper justification.
This is a serious accusation. The DOJ is essentially saying that Walgreens prioritized speed and profits over patient safety, potentially fueling the opioid crisis.
A pretty damning claim.
It is, and what's interesting is how Walgreens is responding. They're claiming they were simply following arbitrary rules, while the DOJ says they ignore very clear red flags.
It sounds like this is going to be a messy legal battle, and I imagine it could have huge ripple effects on the entire pharmacy industry, potentially even driving up the cost of medications for everyone.
That's a real concern. This lawsuit, coupled with the similar one against CVS, could reshape the way pharmacies operate and how they balance profits with patient safety.
So even on a Saturday morning, with a presidential inauguration going on, there's no escaping the complexities of the financial world.
That's the truth. It seems like every headline we've looked at today points to a world that's more uncertain than ever. From oil to crypto to the debt ceiling, the potential for both booms and busts is very real.
It's enough to make your head spin. But don't worry, everyone. We're here to help you make sense of it all.
That's right. We'll continue to unpack these headlines and explore the potential impacts, giving you the insights you need to navigate these uncertain times.
Okay, so we've covered a lot of ground already. From oil markets and the Trump trade to the looming debt ceiling showdown and the legal drama surrounding Walgreens.
And we've only just begun. There's still plenty more to discuss, including some interesting developments in China and the global impact of Trump's potential policies.
Stay tuned, everyone, because we're about to go even deeper into the world of financial news.
You know, one thing that really struck me while reading through these articles was the sheer amount of money flowing out of China right now. Bloomberg had a piece on how Chinese investors sent a record amount of money overseas last year.
Wow, a record. What's driving that exodus?
Well, the article suggests Chinese investors are seeking better returns abroad, which makes sense considering the economic slowdown China's been experiencing.
And I imagine this puts pressure on the yuan.
Absolutely. If more people are selling yuan to buy foreign currencies, it weakens the yuan's value. And this could complicate China's economic relationship with the U.S., especially given Trump's history of trade tensions with China.
Right. And Bloomberg also mentioned that Trump might impose even higher tariffs on China during his second term.
Exactly. So we have this potential for increased economic friction between the two superpowers, which could further destabilize global markets. It's a reminder that what happens in China doesn't stay in China. These economic shifts impact businesses and investors worldwide.
Okay, that's a bit concerning. But let's circle back to the global oil market for a moment. MarketWatch had an article discussing the potential consequences of President Trump's policies in that area.
Yes, and it highlighted some interesting opposing forces. On the one hand, Trump might try to ease sanctions on Russia, which could increase global oil supply and lower prices.
That sounds good for consumers.
It could be. But the article also mentioned that his strong support for Israel against Iran could create instability in the Middle East, potentially pushing oil prices higher.
So it's a real tug of war.
It is. And then you factor in the potential for tariffs on China, Canada, and Mexico, which could also impact global demand and prices for various goods and services. As the MarketWatch article pointed out.
Right. It's this incredibly complex web of interconnected factors.
Yeah.
It's almost impossible to predict the net effect.
Exactly. And it highlights the need for nuanced analysis rather than knee-jerk reactions to individual headlines. We have to consider the bigger picture.
I'm starting to get a bit overwhelmed by all this.
I understand. But remember, the goal isn't to become an expert on every single issue. It's about developing a framework for understanding how these different pieces fit together. Think of it as building a mental map of the financial landscape.
That's a helpful analogy. So what other landmarks should we be adding to this mental map?
Well, Barron's had a fascinating update on the TikTok ban saga. Remember how that was a major issue during Trump's first term?
Of course. It was a huge flashpoint in U.S.-China relations.
Well, the Supreme Court just upheld the law banning TikTok in the U.S.
Wow. So it's actually happening.
But here's the twist. The Biden administration said they won't enforce the ban.
That's surprising.
Right. The ban is supposed to go into effect on Sunday. But without enforcement, it's unclear what will actually happen. And to make things even more interesting, Trump himself seems to have softened his stance on TikTok.
So what's changed?
It seems he's now more interested in finding a solution through political means, potentially involving a sale of TikTok's U.S. operations to an American company.
Wow, talk about a plot twist.
It's a reminder that even seemingly settled issues can be resurrected and reinterpreted in a new political environment.
And that we need to stay flexible in our thinking and open to new information as it emerges.
Exactly. Speaking of new information, Bloomberg had a piece on how Wall Street's hedging craze is making a comeback.
Hedging.
Yeah.
As in protecting investments from potential losses.
Precisely. And it makes sense given all the uncertainty we've been discussing, with Trump back in the White House, and all the potential volatility that comes with it. Investors are looking for ways to mitigate their risk.
So what kind of hedges are they using?
The article mentioned everything from real estate to bond hedges to what are called trend-following vehicles, essentially strategies that try to capitalize on market trends. And it's not just big institutional investors doing this. Even everyday folks are increasingly looking at things like covered call ETFs and buffer ETFs for their defensive properties.
So it's not just about chasing returns anymore. It's about preserving capital in a potentially turbulent market.
That's right. And this shift in mindset really reflects the anxieties we're seeing play out in these headlines.
Okay, so we've got geopolitical tensions, economic uncertainties, and a renewed focus on risk mitigation. What's the takeaway for the average listener?
I think the key is to stay informed. But don't let yourself get overwhelmed. Don't try to predict every twist and turn in the market. Instead, focus on building a well-diversified portfolio that can weather a variety of storms.
That's sound advice. And if we can help make that process a little more entertaining and insightful through these deep dives, then we've done our job.
Absolutely. Knowledge is power, especially in today's complex financial landscape.
Well said. Okay, so before we wrap up, Bloomberg had one more article that I found particularly interesting. It focused on currency trading and how the U.S. dollar is being viewed right now.
Oh, currency markets. Always a wild ride.
Yeah, and it sounds like things are about to get even wilder. The article reports that traders are boosting their bets on U.S. dollar strength ahead of Trump's return.
That's not surprising. Trump's policies, particularly his focus on tariffs, tend to create uncertainty in the global economy. And in times of uncertainty, the U.S. dollar often becomes a safe haven.
So we could see the dollar appreciate in value relative to other currencies.
That's what many traders are getting on, at least according to the article. And a stronger dollar can have significant ripple effects throughout the economy, affecting everything from the cost of imports to the competitiveness of U.S. businesses abroad.
So yet another factor to consider in our already complex financial equation.
Indeed. But that's what makes these deep dives so fascinating, right? We're constantly uncovering new connections and deepening our understanding of the intricate web of global finance.
It's like an ever-evolving puzzle.
And we're here to help you put the pieces together.
You know, as we've been discussing all these different stories, one theme that keeps popping up is the role of government intervention in the markets.
That's a great observation. It seems like the invisible hand is getting a lot of help these days.
Exactly. Whether it's sanctions on Russia, tariffs on China, or the debate over the debt ceiling here in the U.S. governments are playing an increasingly active role in shaping the economic landscape.
And it's not just the U.S. government. Bloomberg had an interesting article about India's nuclear liability laws, for example.
Oh, right. I remember reading about that. What was the issue there?
Well, India has these very strict regulations that make it difficult for foreign companies to build nuclear reactors there.
Which is a missed opportunity considering India's growing energy needs and the potential for nuclear power to reduce carbon emissions.
Exactly. And the article mentioned that the outgoing U.S. ambassador has been urging Indian leaders to reconsider those laws, hoping to open the door for more collaboration in the nuclear energy sector.
So it's a delicate balancing act. Governments want to protect their interests, but they also need to create an environment that encourages innovation and investment.
That's right. And finding that sweet spot is no easy task, especially in a world where economic and political forces are so closely intertwined.
Absolutely. Well, I think we've done a pretty good job of connecting the dots between these seemingly disparate headlines. But before we wrap up, let's bring it back to the listener for a moment.
Good idea. So what does all this mean for you? How can you apply these insights to your own financial decisions?
Well, I think the biggest takeaway is the importance of diversification. As we've seen, there are a lot of potential risks out there, from trade wars to inflation to rising interest rates.
And no one has a crystal ball. It's impossible to predict with certainty which sectors or asset classes will outperform in this environment.
Exactly. So rather than trying to time the market or bet on individual winners, it's wiser to spread your risk across a variety of investments.
That way, if one part of your portfolio takes a hit, the other parts can help cushion the blow.
And don't forget about those hedging strategies we talked about earlier. In times of heightened volatility, it might make sense to explore ways to protect your investments from potential losses.
But remember, every investment strategy has its pros and cons. Do your research, consult with a financial advisor if needed, and choose an approach that aligns with your risk tolerance and financial goals.
Well said. And above all, stay informed. Keep reading those financial magazines, listening to podcasts like this one, and engaging in conversations about the economy.
Because the more you understand about the forces shaping the financial world, the better equipped you'll be to make smart decisions and achieve your financial goals.
Couldn't have said it better myself. So until next time, folks, stay curious, stay informed, and stay invested.
And we'll see you all tomorrow morning with new headlines from major financial magazines.